going to look at kind of turning a powerful strategy that can help you kind of build substantial tax-free retirement assets. And so this is what's considered the Mega Backdoor Roth. But first, we're going to kind of look at the building blocks. So as a recap, we touched on Roth accounts. And so remember, after-tax contributions, growth is tax-free. And then if you meet 59 and a half and 5 years of funding, any withdrawals from these accounts should be tax-free as well. And so with a traditional Roth contribution, the 2025 limits for this year is going to be 7,000 and 8,000 for those 50 and older. So this is considered a catch-up contribution. So this is a simple, if you have 7,000, 8,000 in earnings, right, you can contribute to your Roth IRA. But there's a caveat. There is an income phase out into how much you can actually put in here because you reach a certain threshold. So let's look at the single filers. So if you make under 150,000, you can make a full contribution, either 7,000 or 8,000, into your Roth IRA. Pretty simple. But if you make more than 165,000, remember single filing, you can actually no longer make a contribution into this account. Same case. So if you're actually in between these limits, it's what's known as a partial contribution. So you can't put the max, but you can put some into the Roth IRA. And this is the same for marrying filing jointly. They have their own income phase outs. And so let's look at an example of a partial contribution. So we have a single filer making 153,000. So they're $3,000 into the phase out. And for the single filer phase out, there's $15,000 of range. And so you're going to take 3,000 divided by 15,000. This gives you 20%. And so this 20% is actually what's going to reduce your max contribution. And so 20%, and let's say they're under 50, they're going to try to contribute 7,000. Well, we have to reduce it by 20%. And so 7,000 minus 1,400 gives them 5,600. So this is the partial contribution that they can make. But again, as soon as they make more than 165 to 246,000, they can no longer make a contribution. And so if you can't make a contribution, so what can you do? Well, there's the thing called the backdoor Roth or the Mega Backdoor Roth. And so here is a two-step process. We're going to make a non-deductible IRA contribution to a traditional IRA. So we're letting the IRS know, hey, I'm not taking a deduction this year for the contribution in my traditional IRA. I'm making after-tax contributions. And then we're going to immediately roll it over into or convert it into a Roth IRA. And so this is a two-step approach versus if you were in the below the income phase outs, you would contribute to your Roth. But one thing to consider with the backdoor Roth, the same that would be with the Mega, is that there's something called the pro-rata rule. So put simply, if you already have pre-existing assets in your IRAs, and you go to contribute after-tax money in your traditional IRA and roll it and then convert it into a Roth IRA, well, part of that conversion is going to be taxable. So assume you're putting a non-deductible contribution into your traditional IRA of 7,000, and that 7,000 makes up 10% of your IRA portfolios. When you go to convert that 7,000, 10% is considered tax-free. The other 90% is going to be taxable. And so you want to look out to see if you have any pre-existing balances, because that could throw off the backdoor Roth. And so with the Mega, it's kind of inherent in its name. So instead of making the typical $7,000 to $8,000 contributions to the Roth, you actually have a bigger limit when it comes to utilizing your ConocoPhillips 401k plan. And so if you're younger than age 50, the max contribution you can make into your 401k overall is going to be 70,000. And so this is made up of salary deferrals. So that's going to be either pre-tax or Roth. So again, pre-tax, you're taking the deduction now, pay taxes later. And the Roth is you're paying taxes now, going tax-free withdrawals later. And then the other component to this is going to be your employer match and your after-tax contribution. So the difference between your salary deferral and the 415C limit is 46,500. This bucket cannot be more than 46,500, and this is your employer match and the election that you make to the after-tax bucket. And so there's different age contributions here. And so really the difference between these three is going to be the salary deferral. And so we can see that the beginning one is 22,500, and then for age 60 to 63, it's 34,750. So this just means as you're older, you can get an additional catch-up contribution into your salary deferral. But I can see that other bucket of 46,500 stays the same. So the only thing that would change that will depend on your employer match. So if there's no employer match, you can actually contribute 46,500 into the after-tax bucket. But if there is a match, then your after-tax contribution is reduced depending on the match that your company provides. And so let's look at an example. So we meet Sarah, ConocoPhillips employee. So she's age 57. So when we look at the 401k 415C limits, that's going to be 77,500. And so she has a salary of 250,000, and she's actually going to max out her salary deferral, and she's going to put in $31,000 pre-tax. And so right now we're going to say Conoco is going to match 9%. So that's going to be 22,500. And so when we add her salary deferral to the company match and we subtract that from the 415C limit of 77,500, we actually get a potential room of 24,000 in after-tax contributions. So that means she can put 24,000 of after-tax contributions, meaning you don't take a deduction in that for the contribution you make into your 401k because it's already taxed. But we're not done there, because what we're wanting to do is take that after-tax contribution and do an in-plan conversion, and we're wanting to move that money into a Roth account. Why? Well, because the Roth account grows tax-free. And the reason why you don't just want to leave after-tax money in the after-tax bucket is because any earnings that you would achieve in that account would actually be tax deferred, meaning when you go to pull that money, some of it is after tax, so it's tax-free, but those earnings are actually going to be taxed at ordinary income rates. So we want to make sure when we do an after-tax contribution, we're going to immediately do an in-plan conversion of that 24,000 into a Roth account, just to avoid that. So everything there is growing tax-free. And so that's what the Mega Backdoor Roth is. Instead of contributing 7 to 8,000, you can potentially go up to as high as 46,500. But in this case, she's able to put 24,000 into her Roth. Now, the same case is made here with the regular backdoor Roth. There is the pro-rata rule. So if you already had a pre-existing after-tax amount in there and it has some earnings, well, when you do the conversion, part of that conversion would be taxable. So it's something you want to consider before you fully enact the Mega Backdoor Roth strategy. And so does this make sense for you? Well, it's usually good for candidates who are already maxing their salary deferrals. So if you're already doing that 23,500, you have the cash flow and the savings is aligned with your financial goals, then it makes sense to keep on or to contribute to the Mega Backdoor Roth, especially if you consider your taxes being higher in the future and you're wanting that tax growth to be growing for longer. But if you're not really making that salary deferral, you're not really maximizing that limit, or you have, high interest debt, you don't really have any savings, and you have short-term needs, then maybe this strategy is not really best for you at the moment. And so with the Mega Backdoor Roth, this is unique for ConocoPhillips employees as well as any employees who have this after-tax bucket. And so it helps you build substantial tax-free assets, again, beyond the traditional methods, which is 8,000 and 7,000. So.
All right, Oscar, we have a question. What are the primary risks when performing a Mega Backdoor Roth?
Yeah, so the primary risk is just you want to make sure, like, if, for instance, cash flow, right? So just because you have this option available to you, you don't want to fully utilize your cash flow to save into the mega backdoor Roth strategy, but need it down the road and you need to pull that money. Or also the pro-rata rule, as we mentioned, because if you already have pre-existing balances in there and you have earnings, when you do that conversion, it's going to be taxable. And let's say you've been doing it for years and you've built up a sizable tax deferred earnings in that bucket. Well, that creates a big tax problem when you're going to want to execute on this strategy. So you want to make sure that kind of starting from a clean slate, usually the 401ks let you do in service withdrawal when you reach 59 and a half. And so you're able to kind of move those accounts into traditional methods. So move those tax deferred to an IRA and then after tax to a Roth just to start clean. But you want to make sure that it's not inhibiting your cash flow for your day-to-day expenses. And also, you want to look out for that pro rata.